Cool. Okay. I think we're live. Yay, we are live in our Facebook group, Tax Secrets. I'm gonna let some people come in here. They can see us, and then we'll kind of get started. Okay, cool. All right. All right. So today in Tax Secrets, we have a special guest, Stacy Neal. She's a mortgage lender who I have had the lovely experience actually working with. And I brought her in because of so many of you guys asking questions about, how can I qualify for a home loan? I'm a self-employed business owner. I don't know what to do. And I just thought, why not bring in the expert? So today we have Stacy Neal, and she's going to share with us all the information we need to know on how, as a self-employed business owner, we can actually get a home or know what we need to do to be able to get a home. So I'm going to pass it on to Stacy to kind of take over, and we will have room for Q&A at the end as well. If you guys have questions, just go ahead and drop it in the comments. And I know I'm going to have some too. So Stacy, welcome. Thank you for jumping on today.
Well, thanks for having me.
Yeah.
You're a wonderful client, by the way. So just a little bit about me. I am a senior mortgage banker at Wallach & Holt Mortgage. I've been in the housing industry for 25 years plus. I've been a lender for 8 of those years. And before that, I was a nonprofit housing counselor and also a CEO of a local nonprofit. So a lot of my background has just been helping people become homeowners in all walks of life, shapes of income, assets, all different types of credit scores. So I really do kind of pride myself on knowing a little bit about every situation and how to piece it all together to get people into homeownership. And maybe it's not the normal way, but it's there are a lot of programs out there, especially for our self-employed borrowers. But there have been a lot of changes. And so over the last year since COVID, we kind of break it out into 2 categories. There's pre-COVID, how we looked at income before COVID, and how we look at income after COVID. And the reason is because there's been so many people impacted by COVID-19 in the form of income being received. And that's not just our W-2 clients or clients receiving, W-2 wages, but also in our self-employed clients who had businesses that literally had to stop and cease operation. Some of our restaurant owners, bartenders that are Schedule C, all walks of life, auto companies, car mechanics, all that kind of stuff has been impacted. No one has dodged the bullet, so to speak. And so one of the things that I want to go over today is what has changed, how you can be prepared when your lender asks you for documentation, and what are the other options if a normal, conventional way we calculate it in our little bubble doesn't work for you. And so I want to go over some alternative options that you guys have in terms of self-employed income. So on our screen, we've got just a quick PowerPoint. I didn't want it to be too wordy. I just want to get you guys the information and then answer questions. So one of the things I want to go over is just the type of documentation that we request and why. What we're looking for, honestly, as a lender is stability and continuance. Those are the 2 major things when we're looking at a W-2 income or we're looking at a self-employed borrower. The way that we look at those 2 things are different. So with a W-2 borrower, we're looking at pay stubs, year to date, overtime, bonus, that commission, that kind of stuff. We're still looking at stability. Has it dipped? If it dipped, we've got to have a letter of explanation, and it has to have returned to normal values, normal levels. And is it going to continue? If they're like a seasonal employee and it ends at a certain time, Well, maybe that's not going to continue going forward. So we still look at the same stuff. But for our self-employed clients, we're going to be looking at different types of documentation because you don't have a W-2 and you don't get pay stubs necessarily. So we're going to be looking for tax returns, the last 2 years of your tax return. This is also personal and business. So if you're, a partnership or, some form of SCorp, there's going to be a business return and there's going to be a personal return. There may also be K-1s. We want everything. Give us everything. I get people that send me page 1 of the 1040. Wish that was all we needed, but we need every page, every schedule of your personal and your business returns so that we can see the full picture, full analysis. Usually we need the 2 years because we take a 2-year average of those tax returns. Again, don't have pay stubs. We only have your tax returns. If you're self-employed, this is how you prove your income, which can be a problem, and I'll explain that in a little bit. We also will be filling out, using that tax return, we fill out an entire self-employment income analysis, which I'm actually going to show you in a second. And I'm going to send it to Ashley so she has it in case you guys want to see it on a side note. We're also going to look at not only what you filed the last 2 years, but we're going to be looking at your year-to-date profit and loss. And I have a lot of business owners that don't actually have a year-to-date profit and loss. And so we have to send them a sample or have their CPA send them something to fill out in order to provide us that income. What are we looking for in that year-to-date? We're looking if your income is stable. We're looking if you've returned to pre-COVID levels, if your business has recovered. We're looking at whether, because if you were okay in 2020, but in 2021, you're not okay, well, that's concerning to us too. So we're looking at that year-to-date profit and loss, and we're making sure that we have like one of the most recent months. So if you're applying today, I'd probably get it through April 30th. If you're applying in the first week of June, I would have it through the end of May. So we want it to be really up to date. We're also looking at your balance sheet. Also something that a lot of business owners don't have. So this is something as a business owner, you should be thinking about for your lender. What's new after COVID is we also need your 3 months of your business bank statements and or personal bank statements if you don't have a business account. You should have a business account, but if you don't, we are going to look at your personal account. And what are we looking for here? We're looking to make sure that that income is coming in, that the cash deposits coming in are matching up to what you're claiming on your year-to-date P&L, that also match up to your previous 2 years of self-employment. So what if that doesn't happen? So the analysis that we're looking at impact. We're looking at, here, let me just change this. Impact. So we want to know your whole story. We want to know what happened during 2020 if it was impacted. And we're looking at how you've recovered. We're also looking at your cash flow to make sure that your income is stabilized after COVID, and we're validating that those assets going in, and then determining the income using our self-employment worksheet. So something that we're going to calculate is using your 1040s and also your business returns is called a cash flow worksheet. And I'm going to bring that up onto the screen because I want you guys to see what it looks like. Can you guys all see this?
Yeah.
Ashley, please tell me yes.
Mm-hmm.
Okay. Sample borrower, no one's information is provided here. Just wanted to show you what we use. It's just a formula that every lender, so let me just say this, we all do it the same. So if you gotten told that you can't qualify over here, you're probably not going to qualify over here if they're using the same worksheet. And we all use the same one, guys. So it's nothing new here. We use the same. So we're going to be pulling, and you can see on this board, it says line 31. Line 31, we pull that right from the tax return. So someone that has never calculated this before could follow the tax return and plug in the exact numbers into this worksheet, and it's going to get calculated the same way. So this borrower happened to be a Schedule C borrower. We plugged in 2020 and 2019. In his case, his income was increasing in 2020. So as I scroll down, you'll be able to see it's averaging. So 38,791 for 2020, 2019 was 29,477, and it's taking a 24-month average of the income. He didn't have anything to add back in, like meals or mileage or anything like that. So we were able to use 2844.50 of his income to qualify. Okay, pretty straightforward. Easiest it can be. Never this easy. What we're seeing is multiple partnerships, rental properties. This form can have multiple levels. So I just wanted to show you just the tip of the iceberg, but just know that our team of experts does all this calculation. You don't have to do this for us. We will do it for you. So one of the things I wanted to talk about is with this income calculation, what do we do with this? Well, we determine what you can qualify for. And so if you make $40,000 in net income or an income, and then you write off $39,000 in write-offs, well, that leaves us with $1,000 to work with, maybe a little bit more if we can add some stuff back in. Doesn't leave us with a lot. And so what I want you to know is that those write-offs do impact your ability to qualify. So you'll hear lenders say stuff like, don't write everything off if you're going to buy a house for at least 2 years leading up to, because of this reason. We're going to take a 2-year average, and we're going to make sure that your income is stable. So what if your income's not stable? So this is something that is a very gray area with COVID-19. I sent Ashley a statement. It's actually a lender letter, they call it. And basically, this is what's giving guidance to loan officers and lenders as to how to do an analysis on a self-employed borrower, looking at their year-to-date. So if 2019 was great and 2020 was 0, and the year-to-date is okay, we may not be able to use 2020 at all, clearly, because there's no income. And they're going to really look at your year to date and your previous year to determine if we can use any income at all. And this is not something that your loan officer decides. This is something that an underwriter decides after looking at that package of information that we've provided. So if you're a self-employed borrower, one of the first things I would do is get pre-approved. Make sure your loan officer does all this calculation up front. Get pre-approved, which means have your lender send you to underwriting first before you start shopping for a house. I got a text yesterday from a realtor, and I'm going to read it to you guys because this is the kind of stuff that I get, that I see when I'm not involved. And it is, "Hi, Stacy. It's been a long time. I have a client who's supposed to close in a few days. However, we're running into a few hiccups with the lender. I wanted to run the scenario past you. Borrower has earned $700,000 to $900,000 in income every year, but did not earn any income in 2020. Alarming? I think so. He's an attorney and owns his own law firm, but the courtrooms were closed due to COVID last year, and he's in Texas. This year, he's earned $175,000 with another $300,000 en route. He owns 2 homes outright." She kind of gave me an outline of his assets. "Could your team approve this loan? Could it close in 2 weeks or less?" Basically, the answer is no, we cannot do the loan unless he goes a different route, because he also hasn't filed his 2020 tax return. So what they're using was a P&L that showed 0 income. And if your client is showing that you didn't earn any income in 2020, if you were going to loan that person money, would you feel confident in the repayment of that loan? And as a lender, that's what we're assessing. And unfortunately, this is happening more often because the loan officer doesn't do their due diligence and doesn't review this documentation up front. If I was to have reviewed that person's income up front, I probably would have said, we can't go conventional. We're going to have to go this alternative route, which is something I also want to talk to you guys about. So for the self-employment calculation and all of that stuff, we're talking about conventional loans, jumbo, FHA, VA, USDA, your standard mortgage loans. But there is something called a bank statement loan that we use for some of our self-employed borrowers to identify a true cash flow of your business. Your assets, your income coming in, the income coming into your account, regardless of any of your write-offs. So if you're writing off all of your income, the likelihood of you going a normal traditional route is very slim to none. So you probably will end up going the bank statement route. These are for a lot of our high net worth clients that own multiple businesses. They end up going this route. Is it riskier? Yes. Do they accommodate that risk with other factors? Yes. This means higher interest rates, more money down, a longer close of escrow turn time. So like a normal lender right now, we're doing about 21 to 30-day closings. With a bank statement lender, you're probably looking at 30 to 40 days. And in this market, that will be a challenge. Again, pre-approval, get the pre-approval first. Know that your income is signed off on and looked at, regardless of whichever route you go. And that way you're not going to get stuck at the end in a contract that now you can't qualify for and may potentially lose your earnest money on that house. So what do we look for in a bank statement loan? We actually take 12 to 24 months of your bank statements. Go figure, bank statement loan. We look at your bank statements, 12 to 24 months. And there's actually a spreadsheet, and I have one pulled up that I just wanted to show you guys. This one is one of our investors that buys bank statement loans. You have to know, this is not an in-house product. We broker to these lenders because that's all they do is this specialized programs. Whereas so nothing is really in-house. Although I'm with the clients every step of the way, it is brokered out to another investor that buys the loan. So this is an example of what we're looking for. So all of your income, all of the assets going into the bank account will be put into this spreadsheet, and then an average will be developed. So it's just an Excel spreadsheet that this lender has created. So if I'm going the bank statement route, what I'll normally do is say, send me 24 months of your bank statements. Sounds tedious, and it really is. But I want to take a look at, do you really have assets going in? Do you really have income deposits going in? Because if we're going to go this route, we better know what we're working with. And there's different guidelines for personal bank statements versus business bank statements. So, and different down payment requirements, different FICO requirements. For this program, I want to say it was 660 was the FICO requirement. And the majority of these are at minimum 10% down or higher, depending on what you're doing. So it's not like a one size fits all. It's kind of like we take your situation and try to fit it into one of these programs. And it's not, the rate is usually, I would say at most, probably 0.5% higher than market. So if like market is 3.25, you're probably looking at something in the high threes, and you may be paying points. You may be paying higher closing costs to get this type of product. It's just a riskier loan program. And you have to be along for the ride, because when your file goes to underwriting, they may have a ton of other things that they are asked for. So it may not just be, your 24 months of bank statements. They may ask for everything under the sun, and you may be saying, do they want a blood sample? Because that's pretty much the feeling you get when you're going through that type of an underwriting, and the scrutiny, and every line item is scrutinized. So just something to think about there. We do have those products. So it may not be worth you not writing off all of your expenses if you can just go this route, but just know that there is a route to go if you write off a lot of your expenses, as you should as a business owner. That's the benefit of being self-employed, is having those write-offs and being able to truly identify. But the tax returns don't truly tell us what your cash flow is. So just know it's a different calculation. We have a ton of options. Things have changed after COVID, and the stability and what we're looking for. Hopefully this, I'll definitely be answering questions, but this is just a brief overview of some of the things that we look at. And also just something to note too, with the profit and loss statement, it doesn't have to be an audited profit and loss. which is also scary because you as the business owner, if you don't have a profit and loss, then you're filling it out. And that's what we're using to analyze the continuance of your income. You may want to have somebody look at that before you give it to your lender. Because a lot of times we look at it and we're like, well, this doesn't add up, or this doesn't match anything that they've given us so far. And it's just because they didn't know how to fill it out and it wasn't filled out right. And if it's not filled out right and we give that to the underwriter, it could blow up the whole thing. So we really want to make sure that you're talking with, your CPA, your accountant, who's going to be doing that profit and loss, and just prepare that you will need to have this document as well as the balance sheet. And so talk to your professionals. So I'll open it up for questions. I hope that was like a good overview of what we're looking for as far as self-employed income goes.
Thank you so much, Stacy. That was amazing. I love your, excuse me, I love your spreadsheets. They're amazing.
Yeah, well, they're not all mine. Well, the self-employment one, this one is kind of like a Fannie and Freddie spreadsheet. So this is given to every lender that does mortgage loans. But the bank statement one, they're all the same. It's just different lender at the top. So like that one was Angel Oak, which is an investor we work with. But these are cash flow analysis worksheets. And if you're self-employed, you need to know how we're going to calculate your income.
Yeah, I like want to fill one of those out for fun, honestly.
Oh my gosh.
I love it. Seriously. It's amazing.
Yeah.
So I know I have some questions just because, I work with a lot of people and I get asked certain things, but if there is anyone in the group watching, you have a question, drop it in the comments. I'll read it to Stacy. But Stacy, I know you said get it pre-approved first, right? So how does someone get pre-approved? They find a lender and they go to them and say, hey, I want to buy a house. Can you pre-approve me? Is that basically what they do?
Yes. So obviously it starts with just finding that right person. Ashley has all my contact information, so she can refer you guys over to me. The key is to tell them that you're self-employed from the start. Okay. If you fill out their online application, make sure you're doing it accurately. I've had so many clients that don't know that they're self-employed because they get a 1099. Well, you are self-employed if you get a 1099. Yeah. They don't really see it that way because they work for a company that 1099s them, and then they have someone else do their Schedule C, and maybe not taking advantage of some of those benefits there. But tell them you're self-employed and say, I know I have to provide a ton of documentation. And if your lender doesn't ask for that documentation, run the other direction, because you're going to end up in that situation I just described. That was a real text message, real time from yesterday that I got from one of my realtor partners. So if they are not doing the due diligence up front to pre-qualify you, how do they know what income you can use? How do they know what you can qualify for? Or if you have to go the bank statement route. So give them all of your documentation and say, I know you're going to try to pre-qualify me. Can I get pre-approved though? Because pre-qualification is just a loan officer looking at your documents, which for a W-2 person makes total sense. Let's look at your hourly rate, calculate how many hours you work. Oh, you're off to the races, go shop. With a self-employed person though, if they haven't done these calculations, looked at your profit and loss, made sure that you've got your business bank statements, provided to us, that could blow up at the end. So you want to make sure that, are you going to submit me to underwriting? And if I feel comfortable, like if it's a simple Schedule C, like I showed you on this borrower, I would probably issue a pre-qualification, no problem. If it's, I own 5 rental properties, a partnership, I have farm income, which believe me, we've calculated, and I own 2 businesses. We should dive in and we should submit your file to an underwriter and get your income looked at. The reason is that if there's any questions, let's get them out of the way up front. Let's make sure that your income has been vetted, you've been looked at, so that's just one less thing for you to worry about while you're shopping. Someone's already looked at your income, probably already looked at your credit report too. And then really just, let's go find a property. And so if it's a complicated situation like that, get pre-approved, ask to go to underwriting first. Again, if they say no, maybe they're just not allowed to do that in their company, and then also run the other direction.
Understood.
Yeah.
I love that. So I have a lot of clients who are either Schedule C or S corporations. So I imagine, I can see the schedule here for the Schedule C. I
Okay.
imagine the S corporations, you're pretty much looking at profit and any wages that they receive, or is that pretty much what you'd be looking at?
Yeah. So let me see if I can open up. So there's the partnership. So if it's a partnership income,
Yeah.
obviously a lot of that's coming from those K1s that I mentioned.
Yeah.
So SCorp is down here. I'll send you this form actually, so you have it. Again, K1s. So this is the type of stuff we're looking for.
Cool.
One-time losses, like if you wrote off $100,000 in a one-time loss, what was it? What was it for? Because that one-time loss now makes your income in the negative versus the positive. And so if it's a one-time out of 10 years, maybe it's something we don't have to include. So having those kinds of conversations upfront.
Yeah. So I see you have an adjustment for depreciation. So are you basically adding that back in with, okay. Interesting.
Yep.
I like that.
Yeah. I'll send this to you.
I love
You can
that.
probably Google it and find it. I think it's online, but I'll send it to you.
Yeah. Okay. So I know you mentioned earlier, and I'm in this pickle too with clients because, I preach pay less tax, write off, everything that we can find, right? However, if you want to buy a house, it's a little different. So I did just want to ask you a little bit more about that, because obviously we don't want to pay taxes. We want to get a home, and you have to kind of pick during the 2 years, what one do you want more, right?
And also, if you go the bank statement route, just make sure you have more saved to do the higher down payment.
Got it. So someone could take advantage of tax strategies, tax write-offs, still get a house. It would just be an unconventional method, right? A higher interest rate and everything. Okay. That's cool.
A lot of realtors that I work with actually go the bank statement route because they do write off a lot of their income, as you guys should. I mean, that's the whole benefit of being self-employed, and doing that is not going to outweigh, like, you're still going to get a house. It's just going to be maybe with a little bit higher down, a little bit more closing costs, and maybe a little bit higher interest rate. But the benefits that you're receiving and how you filed your taxes far outweigh going the conventional route. So you should talk with your CPA, financial planner, your mortgage banker, and just make sure, okay, I can't go the conventional route, but what does all that look like? What is my monthly payment? It's probably not going to be that much higher with a slightly higher interest rate, especially if you're doing 10 to 20% down.
Love it. So let's say, we go through and we get pre-approved and we're heartbroken because we didn't get as much as we hoped, right? We can't get the house that we want. So what do we do? Do we focus on, okay, we got to make more money? Is that pretty much it?
There's only a couple ways to do that. Lower your debts.
Okay.
So we look at your debt to income ratio. We look at what you're earning versus what you're paying out in your monthly liabilities, like your car payment, your credit card bills, student loans, that kind of stuff. So you can lower your debt. You can increase your income. That's pretty much it.
Easy formula.
It's called a debt to income ratio, and that's what drives how much you can qualify for.
Got it.
So you either can do one of those two things: increase your income, lower your debt.
Got it. That makes total sense.
So if you can't increase your income and you don't have any debt, then we might have a problem. So then it's okay, so how are you filing your taxes? Maybe a better conversation with your CPA about what you're leaving on the table. Maybe you don't write off as much to give yourself that little additional boost in your average, right? Your 24-month average that we're calculating. But I've had clients, and I get this question all the time, well, what do I need to make to qualify?
I think I've asked you that before, honestly.
And my answer is always the same, and that's I can't tell you.
Give me a number. Yeah.
It's what it is. You're making what you're making. So I can tell you, to have this payment, what your gross needs to be, but it's hard to break that out for a self-employed person because your gross really isn't your net, and there's a lot of moving parts there.
Right.
So I get that asked a lot, and then I don't want to be involved in any type of like IRS fraud or any of that, mortgage fraud. So I just basically say, you know, that's a conversation you need to have with your CPA or accountant, just to understand what the income is that you're earning and how you can show more income to qualify. And if you can't do that on your tax returns, then you're going to have to do that in your income that you're receiving on your bank statements to go the bank statement route.
Yep.
I have a lot of clients that actually do hard money too. Hard money is basically what's like considered a short-term financed loan, which to me is very scary because let's say it's a 12 to 18 month term, higher interest rate, and you got to pay off that lender in 12 to 18 months. Well, if nothing's going to change with your income in 12 to 18 months, what's the end game? What's the plan to pay off that lender? So a lot of people will use the short-term financing to get the house that they want, but then you have to be able to refinance that down the road. And you might end up back at square one again if your income is not aligning with what you need to qualify for. So if you buy $1 million property with hard money, but then you can't qualify for that $1 million, property, even a $700,000 loan, technically, you're going to end up back at square one and going to have to sell that property if you can't refinance.
Thanks. Wow.
It's a little scary.
It sounds scary. Because I know you are physically based here in Arizona, right? But tell us, where do you have branches? So if someone's like, hey, I want to work with Stacy or the company, what states do you have offices in?
So myself and my team, I'm based in Mesa, Arizona. I am licensed in the state of Arizona, so I can basically originate any loans here. If you just have my contact information and you email me, I can connect you with my coworkers in our other states. We're mostly in the Southwest, so California, Oregon, Washington, Idaho, Colorado, Wyoming, New Mexico, Texas, and I think that California. I didn't say that already, but so those are like some of our bigger states. I think we're applying in a couple other smaller states, but those aren't finalized yet. So
wonderful. I love it.
Yeah. So just get in touch with me and then I can connect you to a loan officer in the state you're wanting to buy in.
Yeah, and what I can do is I will drop your contact information in the post here. So if people want to learn more, maybe get pre-approved by you, then they know where to go. So I think
I have one other thing I want to bring up because it's timely and it's something that people have asked me. You're a business owner, you've extended your tax filing, you got an extension. What does that mean to a lender? So I have a lot of clients that maybe got an extension, I think to October is what it is normally. So what we would need is the approved extension. So the IRS approved extension, which is hard to get sometimes.
Yeah.
And then we still need, if we don't have your 2020 return, what are we going to ask for? Your profit and loss for 2020, which at this point you should have, balance sheet for 2020, 2019 and 2018 tax returns. So it's a lot more documentation if you haven't filed your returns. The other thing things get a little crazy with tax transcripts. I'm sure you guys know it's hard to get a hold of the IRS right now. We're actually it's like a 2 to 3 week wait time to get tax transcripts as a lender, but my clients can log right in online and get those for us. So that's what we've been doing to kind of go around their long delays for the lender side of things. Yep. For some loan programs, like if you're doing a down payment assistance program and you're self-employed and we need to get your tax transcripts, those programs require the most recent tax year be filed. And if you're like, oh, I just mailed it in, we may not get that tax transcript back for a while. So
Yeah.
again, all things you talk about with your loan officer up front, make sure you tell your loan officer, I have or have not filed, I am or am not self-employed, this is how I get paid, I don't have a profit and loss. Tell them that at the first phone call, because then we can send you those forms. We have a blank one that we can send you. You can do some research. You can spend some time on it. It's not something you should do a week before you're closing.
No.
Because that could blow up everything.
Yeah,
So
definitely.
just wanted to point that out, because I just feel like extensions are very common with our self-employed clients, and you can still extend, just know that we're going to get some additional documentation from you.
Yeah, definitely.
Oh, I have another one I can bring up.
Hit us. Let's do it.
What if I owe the IRS? So what if you owe the IRS, which a lot of business owners either owe it, and then future year or the next year they'll kind of be on more of like a payment plan, or like a quarterly tax. If you owe the IRS, number one, we're going to see that on your tax return, and we're going to ask you for proof that that's been paid. If you don't have proof, then the next thing is we're going to ask you for an approved payment plan by the IRS. So if you submitted your tax return by mail and they have not sent you the approved plan, and Ashley, that's hard to get too, because of all the turn time issues that they're having, we have to get that, because we have to know what the IRS is willing to accept in your monthly payment plan, because that is a debt that we have to add into your file. Even though we don't know, maybe it's a 12-month repayment, which more than likely it's not. It's probably longer, like 3-5 years, maybe 3 to 5. We have to add that in as a debt. So if you owe the IRS, you either better have paid that off or have an approved payment plan. And if you don't have one, you can call and get it. Now, will you sit on hold for 3 hours? Yes, you will.
Not
Will
a
they
few of us.
you? Yes, they will. If you have a CPA or an accountant that can also advocate on your behalf and call the IRS, have them do that. But when the rubber hits the road, my client ends up calling and gets the payment plan. And they'll fax it to you. And then you can take that fax and send it to us. So just something to bring up. That's another thing with self-employed that we always get is, oh, I owe the IRS $30,000. Well, you either need the payment plan, you need to show proof that you've paid it, or you pay it at closing. That's the other option.
Yeah, here, for those of you who are not wanting to call the IRS, we do have a secret method to getting a hold of them in 3 minutes here at Money Muscle.
I do it. You guys have like a bat phone or something.
Yeah, we have direct access.
Which is so funny, because I had a client who his CPA couldn't get a hold of anybody, and he ended up having to call.
Yeah. Yeah, there's something out there that CPAs can get, and some of them don't know about it. So
that's more reason to work with you.
Yeah, but that did actually bring up another question for me, is because obviously credit score plays a big part in it, how much debt you have. So is there like a credit score range that you need? Like what's the lowest you could probably have?
So we used to be able to do loans down to 580 or sometimes lower, but right now 620 is kind of the hot button FICO score. So conventional has always required a 620 or higher. The down payment assistance programs require a 640, and some of those bank statement loans that I mentioned require a 660 or 680. I was kind of scrolling through a couple of them before the call just to kind of see if those have changed, and normally you're going to have that 660 to 680 to do that specialized program. But more importantly, if you're doing a regular conventional loan or FHA, 620 is kind of the minimum.
Awesome. That's perfect. That's very good.
Now, with just an overall home ownership tip. If you're at a 620, which is the minimum, you're not going to get the best interest rate at a 620. So just keep in mind that as your lender, we talk about everything, not just income. We talk about how to put yourself in the best possible situation to buy a home. And maybe that's not so focused on your income, and maybe that's solely focused on increasing your credit score to then maybe wait a few months, get your score up so that you can get that better interest rate.
Yeah. I know you guys get pretty personal talking about all the debts and all the money and everything. It's good.
We do. We're giving you, lots of money. So we dive into all of the avenues. But my biggest goal is to, make your dream of homeownership reality. That's number one. But also sustainable homeownership. So I don't want to, my job is not to get you into that house. My job is to help you stay in that house. And one of the things, as a lot of people look at us as the bad guy, but we're really just trying to document that you have the ability to repay this debt. And to me, that's a lot of the old way that loans were done was the stated income, no documents needed, no asset statements needed. Like you could just get a loan if you just went and signed your name for $1 million property. But what that led to is the foreclosure crisis. And so what our job now, I think it's fully corrected itself, is you have to prove that you can repay this debt. And if that's a $500,000 loan, that's maybe one of the biggest financial purchases that you may ever make. Yep. So we have an obligation to make sure you can afford that house.
Yeah, and I think it's in the best interest of everyone, right?
It really is. And homeownership is such a good, way to, there's a lot of different write-offs, and I'm not going to go into all that, but it's something that long-term is one of the best investments that you can make.
Absolutely. Well, I do just have to brag for a minute because, as I mentioned earlier in the call, I did use Stacy as my mortgage lender when I bought my house, May 2019, I think. And if any of you guys are trying to buy a house, you got to use Stacy because she was downright amazing. I mean, I talk a lot about the experience I'm trying to provide my clients, but I didn't even expect it from a mortgage lender to take me through this. Like, it was basically like a journey, right? And she took care of everything. She explained everything to us in a easy to understand way. It was just like such a good, positive experience. Even like the hard topics and personal, like, let's talk about the money and all that stuff. Like, everything was amazing. So if you guys are, you have a realtor, maybe you don't have a mortgage lender, connect with Stacy. I'm going to have her email. You guys can connect. She is just amazing. Her company is amazing. They provide like a stellar service. So I appreciate what you do. I appreciate you coming on here and sharing information. I know it's definitely been warranted and really needed. So thank you.
You're welcome. And it's honestly, the pleasure is all on this side, honestly. To have clients that, are quick to respond. This is the key to a quick closing, is quick to respond, working as a team. The lender and realtor relationship there's never been a time where that relationship is more important than now, because it's a very challenging seller's market in most markets across the country. And if your agent is not working with an awesome lender that doesn't pick up their phone, you might have missed out on that bid opportunity that you had. So if you're bidding and losing, you might be with the wrong lender, because what I do is I call the listing agent when an offer is placed. So I introduce myself. I'm like, hey, Ashley just bid on your house on, I don't know, St. Thomas Street. And these are all the great things about my client that I need you to know. And that is so uncommon. Even now, I'm shocked at how uncommon that is. So pleasure's all on this end, Ashley. Thank you so much for having me on. And we've always talked about working together, but we never really knew a way, but this is how, education.
Yeah. Yeah, you're definitely one of a kind. So I appreciate that. Appreciate you
so much. You're so sweet.
Yeah, thank you. Well, I appreciate it. I know everyone in the group is going to love this. So thank you, and hope to do it again with you down the road.
Of course. We'll create new topics.
Yeah, absolutely. I got lots of ideas already.
Do it.
Amazing. Thank you.
You're very welcome. Bye, guys.
Bye.